Well, good evening, ladies and gentlemen. Welcome to yet another weekly Smartkarma forum. Very happy to have you all with us. Quick introduction to the forum. This is a high impact weekly webinar that is exclusive for Smartkarma Plus subscribers. We use this forum to discuss the best, highest conviction insights across the network. We dig deep into themes, and we also allow members to ask questions. The webinar is shorter and punchier than ever before. Just 15 minutes, 3 ideas, 5 minutes of Q&A. Our disclaimer, this is strictly for subscribers. It's purely for informational purposes, not investment advice. It's the opinion of our inside providers and not of Smartkarma, and Chatham House rule applies. Lastly, and importantly, the forum is now available on YouTube. You can see the recordings, you can share them with your friends, and you can follow how some of these ideas have done over time. Today, we will look at 3 ideas: International Game Systems. This is a Taiwanese stock, actually the first Taiwanese company we're ever featuring. Second, we'll briefly look at the recent IPO of PAYTM in India and explore reasons why it did poorly. And lastly, we will look at Sinopec Engineering, a company that is trading below net cash, below liquidation value at the moment. Let's kick things off with International Game Systems. This is 3293TT with a market cap of $2 billion. It trades $18 million a day. So it's a very liquid and actionable name, and it's covered by Douglas Kim on Smartkarma. IGS started off as an online gaming company that was focused largely on arcade games. And over time, they switched from arcade games to mobile games. Today, a vast majority of their revenue comes from mobile games. Quite importantly, unlike what we've seen in China, IGS's revenues are not really affected by China's gaming restrictions for minors. They also have great plans to expand their business into the US market, where they are planning to launch a second platform in early 2022. Which would be a great catalyst for the company. This company makes tremendous margins. Their operating margin is over 50%. And what makes the company even more unique is that it pays 90% of its earnings out as dividends. And it has continued to do so over a very long period of time. So you have a stock that is trading on about 10 times PE, giving you over 7% dividend yield and growing over 50% year on year. This is very rare to be found. And as I mentioned, this is a stock that trades $18 million a day, so it's very actionable. Moving on to PAYTM. This is a $12 billion market cap company. It was even bigger. It was $16 billion, I guess, at the time of IPO. As you can see, the stock has actually fallen off quite significantly since the IPO, and it was the subject of much discussion on news and actually a lot of citations for Smartkarma research providers as well. So why is it that the name has been disliked on the platform? Actually, if I were to switch tabs and show you on the platform, there have been several pieces of research, such as this one, which are red in color. On the platform, the color red stands for bearish ideas that have been disliked by our research providers. And these are typically names where there might be significant fundamental issues, but the market continues to like them. So in the case of PAYTM, actually, it was a case of foreign investors being very bullish and most brokers on the street being very bullish because they were book runners. But domestic institutions largely avoided this IPO. The subscription results of the IPOs were much weaker than that of recent IPOs in India, like Nykaa and Zomato. We're seeing increasing competition, and PAYTM is weakening in terms of its competitive position quite markedly in the last few years. Fourthly, despite its large scale, PAYTM has failed to show a path to profitability. It continues to report large losses. Now, there is a short-term saving grace for PAYTM, which is that given its size, it is getting included in some of the major indices, such as the FTSE index soon, but that might only be short-term relief. That's the view on Smartkarma, and this is not the view that the street had at all. Lastly, I'm going to run you through Sinopec Engineering. This is 2386 Hong Kong. This is a Chinese company that is listed in Hong Kong with a market cap just over $2 billion. This trades $2 million a day. We would classify this as a small or mid cap on the platform. This is a different kind of idea. In fact, this is one of those ideas where it doesn't even matter what the company does. What's very, very interesting is that Sinopec is trading 11% below its net cash position. It's cheap in terms of valuation on almost any single metric. It pays out more than 50% of earnings as dividend, and it's currently yielding 10%. It's also increasing its revenues and profits quite consistently. And even, if this were to be privatized, we would expect about 67% upside based on comparable valuations. So it's one of those names that has extreme margin of safety. Now, when we look at such names, what we try and avoid are companies that are not growing, because if there's a lot of value but no growth, the company's share price might stay stagnant for large periods of time. But if you look at Sinopec Engineering, and I'm going to switch tabs here, anywhere on the platform where you see analytics and you click on it, it quickly brings up high quality financial data on the company. And if we click into financials, you will notice that the company's revenues, which is the green bar, has grown consistently. It, in fact, barely dipped even in 2020, and profit margins have been expanding quite steadily. If we look at it on a semi-annual basis and a larger time frame, again, you see a very, very consistent picture for the company. Now, if we go back to an annual view and look at the balance sheets, it's not very heavily levered. If we look at cash flow, it's been quite good. In fact, the company has made free cash flow every single year for the last 5 years. If we go and look at top shareholders, we notice a lot of long-term investors, Eastspring, which used to be called Prudential, Templeton, Fidelity, Vanguard, AllianceBernstein. These are good long-term holders of the company. And as David Blennerhassett has repeatedly argued in his insight, this is a very, very cheap stock. It is actually trading on a negative EV to EBITDA. A negative enterprise value, not negative EV to EBITDA. So all in all, this is a name with a great margin of safety and a good growth track record that is just simply mispriced at the moment. And with that, I'm at the end of my presentation for today's forum. I'll happily take any questions from the participants. You can always post discussions on the platform and engage our analysts. And you can also send messages to research@smartkarma.com with your feedback, questions, suggestions, or even investment ideas. If you want to ask questions now, you can use the Q&A button on your Zoom application. Okay, looks like there's no questions on the forum today. That's absolutely fine, but we love to hear your feedback through the platform at any given point of time. Thank you very much for joining us today. Speak soon.